Okay, let's take a look at problem 4-7, which is an income statement which deals with some irregular items. Okay, the problem appears in front of you. Wrap Corporation has 100,000 shares of common stock outstanding. In 2004, the company reports income from continuing operations before taxes of $1,210,000. Now, there's some additional transactions not considered. Let me highlight those, or actually, to the left of my mouse here, we'll point to those. In 2004, Wrap Corporation sold equipment for $40,000. The machine had originally cost $80,000 and had accumulated depreciation of $36,000. And the gain or loss is ordinary. Okay, another item they talk about is that the company discontinued operations of one of its subs for the current year at a loss of $190,000 before taxes, and we're supposed to treat this as if it's a discontinued op. The loss of operations of the discontinued subsidiary was $90,000 before taxes. The loss from the disposal was $100,000. Okay, so we've had an equipment disposal, we've had income, we've had some discontinued operations. The third item says we've got some bad debts, it looks like. It's been carried for years and it won't be collected, $26,000. The fourth item says an internal audit discovered that amortization of an tangible asset was understated by $35,000 in a prior period, and the amount was charged against retained earnings. We'll deal with that in a moment as well. And then the fifth item says it sold its investment in common stock at a gain of $145,000. The gain is taxed at 40%, and assume that this sale is an extraordinary item. Okay, well, let's start off with income for continuing operations before income tax. I don't think I listed what the requirements were in this problem, but the requirements are to produce an income statement, and we'll start off with income from continuing operations, since that's all the information we have. Okay, so what do we know? We know income before continuing operations is some dollar amount. We know it's 1,210, but we've got to consider a few things. Okay, item 1 says that they sold equipment for $40,000 that originally cost $80,000 and had an accumulated depreciation of $36,000. Now, that's considered ordinary. So we'll start off with the income from continuing operations of $1,210,000, right? And then we have to subtract out a loss or add in a gain. All right, so now let's just compute the gain right here, and then we'll erase it, or the loss. Okay, so we'll call this the gain or loss for now. And what we know is it had a book value of $80,000 minus accumulated depreciation of $36,000, right? So it had a book value of $44,000. Okay, I'm just going to do this little calculation right here, and we sold it for proceeds of $40,000, right? Okay, so now we're just doing this one little calculation right in here. I just want to, I'll gray this to show you that that's not, it's not going to stay. We're just doing this temporarily. Okay, and so if we subtract then the proceeds from the book value, we realize that that's a loss on the sale. Okay, so now we know there was a loss of $4,000. I'm going to erase all of that. You guys all follow that, I'm sure. Oh, here, let me underline this. Right, book value less proceeds means the loss because the proceeds was less than the book value. All right. With that, we know that that's an ordinary amount, so we need to subtract out that $4,000 loss to come up with income from continuing operations of $1,206,000, and that's before tax. Okay, then the next item we need to deal with. The other items are all what I call below the line. They're unusual items, but we need to consider the taxes, and taxes are 40%. So let's let's drop in income taxes. Okay, now before we tackle the income taxes, I have some check figures that I've used on this problem before, and there's been a change in it. They changed the rate from 40% to 38%, but to make sure I'm consistent with my check figures, I want to change number 5 here to reflect 38%. So let me just jot in a note. Number 5 above should be, we're going to use 38%, a 38% tax rate, I'll say, instead of 40% as indicated above. Okay, so I'll just sort of point that out, and then we'll solve this assuming it's a 38%. So we take the number above, which is now corrected for the equipment sold, an ordinary item, times 38%, and we come up with $458,280. Let me just format this. We may need to do quite a bit of formatting, so let me highlight that a little bit. Okay, then I'm going to underline that, and we'll bring a couple other items to light. Income from continuing operations then would be the 1,206 less the 458,280. And remember, we're using 38% instead of, we're using that 38% instead of 40% on this problem. Okay, so now we have income from continuing operations. The next item we need to work on is discontinued operations. And in the case of discontinued operations, we've had a couple things. We've had, let me slide a little bit. We can get a little bit more information on the screen. Actually, we don't need to slide just yet, but we have had a loss from operations of the discontinued subsidiary. Discontinued subsidiary, right? And normally with discontinued operations, you have two line items. You have the loss itself and then the loss on the disposal, if you've incurred that during the accounting period you're presenting. So the loss from the operations of the discontinued subsidiary was equal to, I believe it's loss of operations was $90,000 before taxes, right? So we'll drop in $90,000, and we format this one with the dollar sign since it's the first time we see that on the column. And if we format this right here, then we have to say less applicable income taxes reduced. Now I'm just simply going to say less income taxes. If I can spell it right. Okay, and then the income taxes is going to be the 90,000 times the 38%. So 34,200. Now we can underline that and do our little subtraction off to the side. Okay, I want to format this cell. We'll use that to format that one. And we now have the discontinued operation loss from the operations of what was discontinued. And also, let me slide this over a little bit. I think we'll need a little bit more room. So I can make this a little bit bigger. Maybe this column a little bit smaller. And then we can continue to slide now. All right, I'm going to slide, give us a little bit more room here. After we have that, the next item with discontinued operations we need to consider would be the loss from the disposal of the subsidiary. So loss from disposal of the subsidiary. I want to indent that as well. And the loss from the disposal of the subsidiary given above, I believe, was $100,000. Let's add a line here so we don't get this confused. Okay, and then again we need to do the less applicable taxes. So I'll just copy this right here, and all of that should have come out just fine, 38% with a 62,000. That's correct. Now we can underline this and add the two losses together, right? Since both were losses. So you see that taxes reduce the amount of the loss. Then we underline that item, and we're able to come up with a line item that I will call income before extraordinary items. Let's bring this to light so you can see this here. All right, income before extraordinary items. And I think we only have one item, so it's not plural, it would be singular. So we've taken care of the first item, the discontinued, and now we take care of income before extraordinary items, do the computation. So we take in from continuing operations less the total discontinued operations.